I'm David Arwood, founder of Tribeca Investment Partners. Calendar 2026 has every chance of looking like a continuation of the second half of 2025. Growth-focused markets likely continue the appreciation we saw in January. Consensus expectations for global growth throughout 2026 look solid enough. And where economies are growing, corporate earnings grow, and in turn, markets tend to rise. Also important to watch is the trajectory of US interest rates, which we predict will continue to ease. The relationship there with growth, as well as the relative strength of the US dollar, will be important to the strategies that we focus on at Tribeca. However, key to our view for 2026 is this: the continuation of this rally necessitates a broadening of the contributors to this rally. That's because the largely technology or portal type stocks that have dominated the performance of recent years are going to have to share some of that market leadership and consequent cheaper capital to enable the real economy to expand. We did see that shift emerge back in the second half of 2025, and the clearest example of that was in materials and commodities, where both the underlying commodities and related equities began to strengthen. We expect that trend to continue to be a driver through 2026. This concentration in mega cap technology we have seen has been a powerful trend, and it will take some dislodging for sure. However, there are forces shaping the global economy strong enough to see this broadening of beneficiaries persist through 2026. The escalation and modernisation of defence spending is a big one, as is the onshoring of manufacturing and the advancements in materials technology that's promoting. Energy demand is also accelerating rapidly, closely linked to AI data storage, and the infrastructure required to support that will be immense. The build out of all that will require materials where undersupply has been allowed to build up now for many years. Overall, growth should continue and market winners by sector and size should broaden. That likely supports an expanding risk appetite, which from a Tribeca perspective is encouraging. It is positive for small caps, for Asia Pacific and emerging market assets, and for materials. It also supports capital creation and equity capital markets activity, which is positive for our advisory franchise and expands the opportunity set for us as investors. Thank you.
Hi, I'm John Stover from Tribeca Investment Partners. 2025 was a strong year for global credit returns, with supportive economic growth, solid risk sentiment, and US interest rate cuts helping boost returns. Asia credit outperformed other regions such as the US and Europe for the second straight year, with both the high yield and investment grade indexes outperforming by about 1%. This follows an even larger outperformance in 2024, where Asia high yield bonds outperformed by about 7% and investment grade bonds outperformed by about 2%. Looking ahead to 2026, we expect Asia to continue to outperform. Asia credit offers higher yields relative to the US and Europe for the same credit rating, with the high yield index currently yielding about 7.5% compared to 6.5% in the US. And Asia, excluding China, has lower default rates than other regions, both historically and in recent years. Asia, excluding China, is the core focus of our strategy, and we continue to have light exposure to China. Asia credit is also a lower duration market compared to the US and Europe, which means it's less sensitive to changes in interest rates. This is important at a time where we see modest risk to the upside for longer-term interest rates. Asia credit also outperforms in periods of US dollar weakness, as a weaker US dollar reduces debt servicing costs for issuers and typically triggers a capital rotation from the US into Asia and emerging markets broadly. We continue to see very attractive opportunities in countries like India, where a rising middle class and supportive demographics are driving structural growth, but still offer very attractive yields for corporate bonds. In terms of default rates, we continue to see a benign environment for Asia in 2026, following a year where there were zero defaults in Asia outside of China. Asia credit already went through its default cycle in 2022 and 2023, and the surviving corporate universe is much stronger, having weathered a period of 2 years where the high-yield bond market was effectively closed for refinancing. In contrast, we think defaults in the US will continue to rise, particularly in private credit. This is likely to be driven by the relaxed lending standards over the past several years and weakness in certain pockets of the economy where loan growth was very large. In terms of interest rates, the US made 325 basis point cuts in 2025, and we expect the US to continue to cut in 2026, while other central banks in the region, such as Australia and Japan, are likely to hike rates, creating divergent monetary policy conditions worldwide. Our Tribeca Asia credit strategy invests primarily in US dollar bonds from Asia-Pacific issuers, so it is more exposed to the US dollar yield curve. With a new Federal Reserve chairman coming in 2026, we believe the Trump administration aims to run the economy hot, cutting short-term interest rates to stimulate the economy. However, this may come at the expense of longer-term Treasury yields, which we believe will rise modestly in 2026 as investors worry about central bank independence and global investors reallocate away from the US at the margins. Therefore, we have positioned our portfolio at the short end of the yield curve with an average duration of 3 years to maturity, and Federal Reserve cuts should benefit bond prices in the portfolio. Overall, we are very constructive on the outlook for Asia credit in 2026, and we believe it will be another year of strong returns. Thank you.
Hi, I'm Shushanta Majumdar from Tribeca Investment Partners. We believe the listed infrastructure asset class has some unique alpha opportunity within Asia. The infrastructure asset class, by nature, is low beta and defensive because of its stable cash flows and can be an effective inflation hedge as well as a diversification candidate. Within infrastructure, the listed assets provide superior liquidity and lower fees, and the quality of these assets are equally, if not better, than in the private space. Today, they are also trading at an attractive valuation discount. Tribeca Asia Infrastructure Fund invests in quality infrastructure assets across Asia and across subsectors. Looking forward to 2026, we believe the infrastructure asset class will continue to show a secular growth, with the potential upside coming from China's AI capex, as well as recovery in China's consumption. In 2025, certain infrastructure themes like digital infrastructure, such as data centers, significantly outperformed, and we believe this strong performance may continue. But we also believe other themes within infrastructure, like energy security and transition, as well as healthcare infrastructure, should continue to deliver secular growth. Looking back, 2025 was quite an interesting year where more than 50% of the returns in Asia Pac came from a single theme, which is AI and tech, driven by capex spending of the US hyperscalers. Semiconductor names contributed more than 40% of the market return. The asymmetric upside from AI capex, power, and defense were disproportionately rewarded, while quality stocks underperformed after 2 decades of their outperformance. In fact, quality stocks had the worst year since 2009 as tariffs and other economic uncertainties hit the corporate confidence. In this context, we believe very strongly that investors should diversify ahead of the crowd into secular growth assets, as macro risk, particularly signs of inflation or stagflation, could render the over-owned assets vulnerable. Thank you.
Hi, I'm Ben Cleary from Tribeca Investment Partners. In 2025, the global natural resources sector rallied 25%, largely driven by stronger than expected demand for commodities from the ongoing AI and data center boom, a weaker US dollar on falling rates, and a broadening of the stock market rally, which saw commodity producer equities supported for the first time in 3 years. For 2026, consensus expectations point to a further 20 to 25% move higher for the sector. At Tribeca, within the commodity complex, we maintain a preference for precious metals, base metals, and critical metals over ferrous metals and oil. We continue to see attractive valuations for commodity producers and expect sequential earnings upgrades to consensus numbers in the first half of the year. US demand alone increased by more than 1% of the global copper market in 2025 and is expected to rise further in 2026 at a time when the copper market is already in deficit. Third, the long-running theme of underinvestment in new mines is likely to persist, with major miners often preferring to buy rather than build. A lack of new discoveries has contributed to record low exchange inventories and ongoing supply deficits, even at higher prices. After investment declined in 2025, we believe commodity prices may need to rise meaningfully before there is a material supply response. Natural resources have lagged technology and financials for much of the past 40 years, but we see the potential for the current rotation to last. Financial investor exposure to the sector remains low on a historical basis, and as returns improve, we expect allocations to rise as the sector becomes more relevant. Combined with the unwinding of ESG-driven outflows, this makes the outlook for 2026 particularly encouraging. Thank you.
Hi, I'm Simon Brown from Tribeca Investment Partners. Today, I'm talking about equity markets. Global equity markets delivered strong returns in 2025, with the MSCI World Index up around 22%. Beneath the headline result, non-US markets outperformed the US by around 10 percentage points. The key question is whether equity market performance can continue into 2026. We believe it can, because growth is accelerating and broadening. This supports a constructive outlook for markets, and we expect returns to rotate across sectors and geographies. As an Asia-Pacific equity specialist, that's an encouraging backdrop. What themes could drive this broadening in returns? We believe the shift is already underway, supported by defence spending, reindustrialisation, and the rebuilding of strategic capability. It's difficult to see geopolitical conditions becoming less volatile, and this is creating pressure on Western governments to increase defence capabilities for themselves and their allies. On reindustrialisation, the pandemic exposed vulnerabilities in global supply chains and has driven a shift towards redundancy and sovereign capability in critical areas. That shift is being enabled by advanced manufacturing, which is pulling through high capital expenditures and increasing demand for raw materials. In Australia, it's also important to highlight gold. The sector returned 127% in 2025 and is now a meaningful part of the market outside of the top 20 largest companies, and too large for investors to ignore. The cash flows are substantial, and we expect capital to flow into exploration, mine development, M&A, and capital management. These companies could be materially larger a year from now. Another key factor for 2026 is M&A and equity capital markets activity. If these themes play out, the ECM revival seen in 2025 is likely to accelerate in 2026. In summary, we believe markets can rise, but leadership will need to broaden. There are multiple reinforcing themes that support that outcome, and a combination of broadening returns, rising capital activity, and a potential regional shift in performance is constructive for the opportunity set. Thank you.
Hi, I'm Scott Clements from Tribeca Capital, the corporate advisory arm of the Tribeca Group. If I had to summarize our view for the coming year, it would be cautiously optimistic. 2025 was a strong year for markets, and 2026 looks set to build on that momentum. While geopolitical headlines will remain noisy, the macro environment should be supportive, underpinning growth and sustaining investor appetite for equity exposure. Global equity issuance increased 25% year-on-year in 2025, marking the strongest level of activity since 2021. And Asia-Pacific was particularly strong for IPOs and equity financings. India and Japan were very active, and Hong Kong was the world's #1 IPO market, supported by renewed investor interest in Greater China. Looking into 2026, we see a strong pipeline of Asia-Pacific IPOs led by technology and other new economy themes, including in Australia. The ASX rebounded strongly in financing activity last year. By the third quarter, IPO numbers had already exceeded the prior year's total, and activity was broad-based across sectors, setting up momentum and deal flow that is carrying into 2026. And our business reflects this. We have a full pipeline of corporate clients we're helping to prepare for an IPO, raise capital, or pursue corporate expansion through M&A. Tribeca has a traditional strength in natural resources, which performed very strongly in 2025. We expect continued interest in precious metals, critical minerals, energy, and nuclear themes, where we were very active globally. These are complemented by growth in related themes, such as defense and advanced manufacturing, particularly where they intersect with critical mineral supply chains. We also see continued ASX investor interest in innovative healthcare and technology companies, especially those with regional or global footprints. From our perspective, the ASX is the standout exchange in the region for small cap equities, and arguably globally, supported by one of the world's largest pools of pension capital. Australia's superannuation system supports the valuation and liquidity of ASX companies, alongside a very active retail investor base, historically focused on small caps. Combined with lower barriers to listing for early-stage growth companies and a strong corporate governance framework, these factors make the ASX a compelling venue for small cap companies from Asia and around the world that need to raise capital. We're looking forward to an active 2026. Thank you.